There we go. I'm going to give you guys a quick intro to myself and then how I got into this. So, Patrick McMillan, I'm a transaction advisory and CFO consultant for a firm called Amplēo. We're based in Salt Lake City, Utah. However, we have consultants all over. We've got over 150 consultants across the US. We've been around for 30 years, roughly. Most of our consultants are CFOs. We have controllers, CMOs, and HR professionals as well. I got involved with transaction advisory years and years ago when I started and sold one of my companies, a very small company. Didn't think much about it until I became a corporate CFO for some a group of restaurants and fun centers and everything. We owned the franchising rights. We had several franchise-owned stores as well as franchisees. And it felt like about every week the owners would come in and say, "Hey, PMAC, we've got a restaurant that we sold, we've got one that we bought, and we got one that we're trading, and we're closing down this one, and we're opening this one, and this is Monday morning, and we need everything done by tomorrow." So hence no hair up here. I spent a few years doing that, and I had no idea what I was doing. And so I learned real fast and real hard how to figure it out. And it was fun. It was crazy. It was fun. I left that corporate position to become a CFO consultant, picked up some clients, and then a few years later joined what was called then Advanced CFO. And since we've rebranded to Amplēo, we amplify resources. So I lead our transaction advisory team, and this is a lot of fun. Marcus, who's on the call today, glad that he's here, and I think we might have a couple of our consultants on today as well. So grateful to have you guys here. All right, so enough about me. Let's just jump right into it. We're going to talk about networking capital. Now, I'm going to have a bit of an assumption here and assume that everybody knows at least a little bit about it. If you don't, it's okay. This is an open forum. This is a safe environment. We hear about that. Please feel free to ask questions. I'm going to give just a quick background about what is networking capital, and then we're going to dig into kind of some of the details surrounding it. So right here, this is one of my, it's a 3-statement model. It's just a test company. I've gone through and kind of revised a whole lot of information on a previous transaction a while back. 3-statement model where I put the income statement, and then below here you'll see the balance sheet, and then from those I composed a statement of cash flows, and then there's the adjusted net working capital, and that's where we're going to spend a lot of our time. So we have the months here, and then right here is just where I have the totals. So net working capital, what it is essentially it's what a company needs as far as cash, how much cash in order to operate. That's a very simplified version of it. Typically, during an M&A transaction, when a company buys or sells themselves or another entity, what they're doing is they're operating on what's called a cash-free, debt-free basis. In other words, the sellers will strip out the cash and pay off all of the debt, and then whatever is needed to operate the company on a going forward basis, they will leave in the transaction in order for the new owners to continue working. And so that's why when you see people working on, it's called adjusted net working capital, you don't see cash right here and you don't see debt. Now let's define debt for a second. Interest-bearing debt is the definition of this one. So what we're going to do, the way that I work on my adjusted net working capital sections here, just in the workbook, and there's a million different ways to do this. This is just one of the ways that I do it. I'm sure people have seen and worked on others that are doing it different ways. It's totally fine. So I like to put the sales and cost of goods here because those are going to drive a lot of those key metrics and everything that we'll talk about down here. So you'll see, I'm going to hide the statement of cash flows for a second because we are just going to basically come up here and look at the balance sheet. So you'll see the current current assets right here. There's cash, AR, inventory, and then other current assets. And you'll see those except for cash right here. So there's the accounts receivable, inventory, and other current assets. And then the same thing for the liabilities. There's the accounts payable, credit cards, payroll liabilities, sales tax, excuse me, and other current, which you'll see right here. Those are the primary drivers. Now, I'm keeping this simplified. We'll talk about some anomalies here a little bit later. And so I like to have these where I've got pluses, for all the assets and minuses for all the liabilities. That way, when you just sum those, you can see on a monthly basis what that particular month's net working capital is. And then below here, you see the metrics. You see the DSO, day sales outstanding. In other words, it's how quickly are you collecting cash? How quickly are you turning it from accounts receivable to cash? And I do it on a 90-day average right here. It's pretty typical. Doesn't mean you have to do it that way. That's typically how I work on them on deals. Sometimes I'll adjust it in different ways. And so there's the DSO, the day sales outstanding. Same thing for days payable outstanding, 90-day average. That basically says how quickly are you paying off your accounts payable. And so you can tell that this firm's doing it, generally around, AR is generally around 30, 35, 40 days. And then their payables generally around 10 days. And then here's another one, days on hand. So this is talking about inventory. This is an inventory metric. You're basically explaining here, how many days of inventory do you have on hand? Which also tells you how often are you turning your inventory? How quickly are you turning through that inventory on, and I calculate that on an LTM or last 12-month basis. So these are really a lot of the key metrics that you'll see when you're talking about net working capital to help you figure out, hey, how much net working capital does this company need? A lot of times you'll see purchase agreements that'll really spell out some specific metrics that need to be involved and everything. That's another conversation for another day. These other two, this is your net working capital ratio. It's basically you're just looking at your assets as compared to your liabilities. Obviously, you want to have more assets than liabilities. If not, then get into some other cash issues. And then your cash conversion cycle. Now this, I just want to show you that formula real quick. It's pretty simple. Cash conversion just tells you how quickly are you converting cash out to cash back in? How quickly does it take you from when you have to send money out to buy inventory or to pay your vendors to where you're getting money back from your customers? And as you can see on this, we're looking at an average of around, 40 days. That formula is very simple. DSO plus DOH, your days sales outstanding, plus your days on hand, minus money going out. That's all it is. So let's bring all this now to where we're just looking at on a monthly basis. I'm going to look at just financial year 23. Okay, so our DSO is 39 days, our DPO is 9 days, and our DOH. What does all this mean? Don't worry so much about the metrics as far as the calculation. The metrics right now are basically, we're just wanting to look at and say, hey, are they collecting money quickly enough? Are they keeping their vendors happy? And are they churning through inventory quickly enough to where they don't have a lot of overstock that they're just not selling? That's the general basis of that. That's not so much what we're going to dig into today, unless we have some specific questions on that later. What I really want to dig into is what is the actual adjusted net working capital? And if you look at the formulas here, there again, what I'm doing is I'm just indexing whatever that's, I'm looking at TTM October, actually. Let me change this to December. There we go. So if I'm looking at financial year December, then that's basically just looking at this particular month right here. Now, That just means just for the month of December, the company needed or operated on $370,000 of net working capital. Okay. In order to, for the next while, that's what they would need. Now, during deals, when you're in an M&A transaction, a buy side and a sell side will both come up with, and we're going to dig into some of these details a little bit more. Okay. They'll come up with what's called a PEG, net working capital PEG. In other words, how much on an average basis, because you can see from each month, this fluctuates. This is a great example right here. We're looking at August to September. We're swinging right here quite a bit, almost 100 grand, okay? And the reason why is if we look in here, we're seeing that accounts payable increase. We're seeing that credit cards increased. We're seeing a lot of fluctuation here. And so that's why you want to look at your averages. And that's what these are. This is a 12-month average. Here's a 6-month average and a 3-month average. Very simple. Okay. Now, there again, I'm keeping this very simple because there are a lot of nuances that we will, I'm sure, get some questions about, we will discuss. What does all this mean? Let me come back to this for a sec. So here again, December, okay? We've got an average of 324 for the last 12 months, 350, 350. And so if I were advising on this, I would say, and looking at kind of the nuances of the last bit, I'd say it's probably going to be somewhere between these. Matt even probably say right at 350. So let's keep this in mind. I'm going to set this aside for a sec and walk through why is this important in a transaction, okay? You can't really, it's an art and a science, but it's more of an art than a science right here. So on a transaction closing, actually, let me come up here. So you can't accurately measure it before closing dates. And there's two reasons why. Number one, let's say you have this is through December. Let's say your closing date's going to be February. Come February, you're going to need to know for the transaction, well, how much net working capital do we need from February for the next several months? But you're not going to know that prior to closing the books. And so you have to have those assumptions in there and say, well, we're going to assume that that's going to be, about 325 or 350,000. Okay. But then you have to adjust it afterwards. I'm going to show you how this works here in a minute. So I just kind of want you to digest this for a second. Okay. It's impossible to know what it's going to be on a future date. It can take weeks for a company to close its books. And so therefore you have to basically make the assumptions. And how do you do that? On the transaction date, and I'm going to upload this to my Zoom, to my LinkedIn. If you see the event on my LinkedIn profile, then you'll be able to download this. I'll upload this. I'll figure out somehow where you're able to get this on there. And if nothing else, email me and I'll send it to you. So anyway, on a transaction date, the buyer will pay the seller an initial purchase price. We're going to look at an example here in a sec, so just digest this. You're going to set an initial purchase price, and it's subject to an adjustment. And that's the adjustment that we're going to talk about here. The initial purchase price will include that estimate, that $325,000 or $350,000 estimate of a PEG. Okay? It's called the target net working capital, or the PEG. It's also referred to, I just mentioned that. So after that transaction's close, and then the accounting team has closed those books, then typically within 60, 90, or 120 days, then they're going to come back and they're going to say, okay, now that we've closed the books, we know how much net working capital was actually needed. And now we're going to go ahead and go back and forth and really initiate what that is. And that's called the, oh my gosh, the final working capital. There's another word for it, and it's leaving my mind right now.
True up.
This is, the true up. Thank you, Thomas. I'm like, I know Thomas will know this. It's the true up period. Thank you, appreciate that.
You got it.
There again, we're going to look at some examples here in a sec. If that true up amount, if that actual final working capital is more or less, and that'll tell who's going to get that difference. Okay. I'm going to do an example real quick, and I got this from Peter Lynch. I love R&D. What does R&D stand for? Rob and duplicate. So keep that in mind. I learned that years ago, and it's stuck with me ever since. So Peter Lynch, when a healthy business is acquired, the purchase price is based on a multiple of earnings, usually multiple of EBITDA. So many arguments here. Another discussion for another day. I love it. What the purchase price assumes, among other things, is that the business will have adequate working capital on the date it's acquired to maintain its leverage of earnings. Here we go. Here's an example. So now everything's going to kind of start coming together. Okay. Hopefully you guys will really understand why this is important. Here's an example for it. Let's eliminate all working capital accounts with the exception of inventory. There again, it's a current asset, right? Assume you acquire a business that uses raw materials to sell a finished good. Post-acquisition, you learn that the business doesn't have any inventory. It's an extreme example that hopefully never occurs, but this helps you to understand why proper due diligence, why someone like us is important to help buyers and sellers understand the nuances between this, okay?
Let's do it.
Without raw materials.
Tell me, what is the KPMG way? I will do it.
Without raw materials, production would halt, and you'll have to use cash you did not initially think you'd need, cash to purchase more inventory to continue operating. Now, there again, that's like, oh crap, I thought they were going to leave the inventory in there, or the seller's like, oh, well, we're too involved in this transaction, we forgot to buy inventory. There again, it's an extreme example, but it's an example. So in that event, then the buyer, after they close the transaction, then they're going to have to come up with more cash to buy inventory, which, there again creates other issues because now you have to wait for the inventory to come in. There's a lot of issues that become involved here. The working capital adjustment in a stock purchase agreement secures that cash from the sellers to make sure that the buyer is made whole. In other words, working capital adjustment make sure that the buyer receives historically normalized, there again, we're normalizing earnings and cash and things like that, right? A normalized level of working capital at closing so that the business can be operating as it was prior to the transaction. What does this look like? Now, you're probably hearing this and kind of seeing, okay, what does this look like? How do you do that? Here we go. It's called purchase price adjustment mechanism. So we're going to use these financials as an example. Here's the EBITDA. I just pulled it right here. Let's say we did a quality of earnings. It's my favorite subject. Don't get me started. Okay. And the EBITDA 1,335,787. There we go. Let's say the buyer's paying a 3.5 times multiple of EBITDA. There's your enterprise value of the company. Enterprise value, base purchase price, initial purchase price, same thing. Okay. And you'll hear a lot of names thrown around. Make sure that when you hear these names, whoever's throwing those around, that they are telling you the same thing that you're thinking, making sure that you guys agree. Are we talking about enterprise value, which is base purchase price? I mean, let's make sure we're talking about this, okay? So that's that base purchase price. Now, when you looking at the stock purchase agreement, here's how you figure out what the actual purchase price is, the adjusted purchase price, okay? There again, we talked about cash-free, debt-free. The sellers are going to strip out all the cash. They've earned that cash. That's been their business up until that closing day. So all that cash that's on the balance sheet that we see right here, there's $125,000 of cash, they're going to pull out. They're going to take that home with them. They're also going to pay off the debt, the interest-bearing debt, because they're the ones that incurred that debt. So this debt right here, it was basically the PPP loan, because keep in mind, interest-bearing debt these other current liabilities, whatever they were, they didn't bear interest, sales tax. Now, there's some nuances around this, but like I said, we're keeping all this simple. Okay. So there's a debt that they're also going to pay off. And plus, whatever the transaction expenses are. That's the attorney fees, that's the quality of earnings, that's, other things that are involved here. It could include, a broker fee, things like that. And there's right here is the ending purchase price. Okay, so now you can kind of see how this changes a little bit. Let's talk about the working capital portion. Again, when we were looking here, we said, we're gonna go somewhere between 325 and 350. Let's just go with 350. The target is 350,000. Okay. And let's say, remember, again, we talked about this, the true up period. Oh, look, Thomas, there it is. If I just kind of read a little bit, I would have seen it. But thanks for jumping in. So let's say that that after the true up period, we targeted 350 and they both said, hey, you know what? We were right. We closed the books and we were spot on. It actually is 350,000. Then there's no adjustment. That's rarely ever the case. I have seen that happen a couple of times, not often. The final working capital, we're going to go back to our extreme example here. Okay. Let's say that they stripped out all the inventory. Let's say it was completely zero. Okay. And so they targeted 350, but there is nothing left in there. And so, oh my gosh, we have to pull out some money. We have to be able to use this. And so the sellers are going to be the ones that actually have to come up with that. Okay, that 350,000. I'm going to give another example here in a second that'll really help too. Actually, here we go. This is this example. If the final amount is less than the target, then that's called a shortfall. Okay, then the buyer and seller instruct the escrow. So what happens is this peg, this target amount gets put into an escrow account. Okay, this is a typical transaction. Not every single time, but this is typically what happens. It gets put into an escrow account. And in order for the escrow agent to release that escrow account, they have to have an agreement between buyer and seller. They both have to agree upon how much gets released and to whom. So if it's in a shortfall amount, like we have in this example, they stripped out all the inventory and there's no inventory, and oh my gosh, now we have to buy some inventory. Then the buyer and seller are both seller's going to know they stripped out the inventory, they forgot to buy it or whatever. And they're saying, oh crap, our bad, sorry, you're right. And buyer's going to say, hey, we looked at it, we were right at the $350,000 target, but there was zero in there. So, okay, we agree, 350,000. We're going to instruct the escrow agent to release that shortfall amount to the buyer. There again, that's what protects that buyer to be able to say, well, now I can go back and buy that inventory. That money was already set aside. I don't have to come up with my own cash. It was in that escrow account. Now, let's say the opposite happens. Let's say they left in there 500,000. Man, I tell you what, there's some nice sellers, right? I wish I could keep all that extra $150,000. Not the case. Your purchase price bumps up a little bit. That adjustment right there is what bumps up because you're buying that extra cash that was left in there. Essentially, here's how that works. The final amount's greater. It's an excess amount, right? So that's where the buyer will they'll pay that amount to the seller and they will instruct the escrow agents to release all the funds from that escrow. Remember, there was 350 already in there. Buyer's going to pay the excess 150 and then everybody's made whole. That's where that extra 150,000 comes in. It's that purchase price adjustment mechanism. Very simplistic example. Now, how does all this work, in the end when you're saying, okay, well, what about that true-up period? What does that look like? How does that happen? Typically what happens is the buyer will, after the books are closed, after the transaction and the books are closed and everything, the buyer's going to deliver this statement to the seller and say, hey, we've calculated the final net working capital to be X, and here's how. Okay. This is just a sample one. I can't even remember who I R&D'd this from. It may have been Peter Lynch as well. Actually, I think it was. So here we go. So here's the stock purchase agreement. They basically go in and they just look and say, okay, here's cash. Of course, it's not included in net working capital. Here's the AR and doubtful accounts. Here's the transaction. These numbers are not going to match the financials. These are just complete other numbers. So don't try to match that. So basically, you're going in here and you're just looking, at adjustments. These adjustments, you have to make sure these are spelled out in the purchase agreement, because if they're not, there's a phrase that I use. You have agreements to prevent disagreements. Make sure that you spell out every single account and whether or not it is or isn't included in the net working capital. Okay. And so there's your, thought I froze this. Hold on a second. There we go. Wrong side. Hold up. There we go. So there's your reported amount. There's the adjustment amount. Then you say, okay, our net working capital target was X. Here's the purchase price adjustment. This is just another way to look at it. There again, these numbers aren't the same, but buyer will deliver this to the seller, and it spells out in the purchase agreement how long or at what time frame they need to deliver that. The seller will take a look and say, oh, we agree. You know what? No, it really should have been this. And they might, go back and forth. And then once they come upon an agreement, then that's when they go to the escrow agent and say, hey, there's an excess, so there's a shortfall. Here's who gets released to what. Now, let's see. Where is my Zoom controls? Here we go. All right. I am going to jump into the chat for a minute, and now we're going to enter into some discussion. Here we go. Patrick Lambert, is there ever a scenario when the average net working capital isn't actually what the company needs? Absolutely, all the time. There's so many nuances involved here. And Marcus, I think you were even talking about, I can't remember if it was yours or someone else's who was sharing in our Slack channel about kind of one of those situations. Was that you, Marcus? Will you share a little bit about that?
I was specifically referring to a valuation where more than half the value, well, up to about 40% of the value is going to be a working capital adjustment. And so it was a major point of discussion.
That's right. That's right. So, will you explain that a little bit more so people can understand what you're saying there? And Patrick, I know this doesn't quite answer your question. We will here in a sec, but I want Marcus to kind of press a little bit harder on what he's talking about here.
Sure. So a lot of people look at the valuation at some multiple EBITDA, and in their mind, it's done. And sometimes net working capital, especially to this point where it's more than the company traditionally has had more on their balance sheet than they need. So the strategy is to revert to some bank necessary ratio in computing the PEG amount and adding that to the EBITDA based valuation, and that's your actual enterprise value.
So in other words, you're saying, let's say valuation was 10 million, but net working capital was like how much? Like 8? What'd you say it was, like 40%?
Yeah, they've been carrying twice as much as they need. So they've been carrying 8 million in working capital.
Oh, gotcha.
For various reasons. And so now, I mean, if they just go with historical working capital, they're going to give $4 million away. So you convince the other party that, hey, this is bank required ratio would generate a working capital of 4 million. So we're going to add that $4 million to our ultimate cash out.
Oh, so you're saying kind of in this situation then.
Yeah.
There we go. So that's, and so you guys see how the net working capital can drastically change the adjustment mechanism can drastically change that purchase price. Is this a good illustration of it, Marcus?
Yeah, again, depends on the balance sheet. This is kind of a weird balance sheet. They
Right.
haven't been managing the capital very well. They had lots and lots of just stuff idle on the balance sheet.
Yeah,
No
good.
sense in giving that to the buyer.
Thank you. So Patrick Lambert, so is there ever a scenario when the average net working capital isn't actually what the company needs? Yes, I actually just recently was advising on a transaction where the net working capital, according to our formulas, was about $1 million, but it was truly about 200,000. And the reason why is because the company had a huge AR number that was in there that was not accurate. There were a lot of adjustments in there. And so we really went back and forth between buyer and seller. I was representing the buy side, but we had some great discussions about, what those adjustments were. So yeah, many times, and that's where you really got to have some consultants, some advisors involved who understand the nuances of the company so that you can really go in and make those adjustments as necessary. Thanks for asking that. Let's see. Next question. Also, Patrick Lambert, would auto loans have to be paid off? That really depends upon the transaction. A lot of times on auto loans, sometimes they are business vehicles and sometimes they are personal vehicles. And so really that involves the negotiation back and forth between the buyers and sellers. If they are company vehicles and they are, they're again interest-bearing debt, then I typically advise, yes, pay those off. But there again, those are adjustments that buyers and sellers can go back and forth, and you just have to make sure that you adjust that net working capital accordingly. Let's see, Philip, can you clarify the debt payoff? In your sheet, it looks like 128,000 is annual PPP debt payments, but I think in your adjustment, you're referring to the payoff of total balance. Let me share my screen again. Let's see. And then get your question pulled back up here. Hold on a second. Here we go. So the balance sheet, we got, yes, the 120,000 was the PPP. And that's because I just, on this particular example that I'm giving, that's the only interest bearing one. A lot of times you'll have, kind of some others through here. And you'll just need to make sure that that debt payoff is you're paying off all interest bearing debt. And you may have this right here are going to condense financials. Usually the actual raw data, the raw financials will have several different GLs of debt. And I just try to consolidate those into, a few different lines. Philip, if you don't mind, I believe I'm addressing your question. If you don't mind, take yourself off mute for a second. Help me to make sure I'm addressing your question here.
Yeah, my main question on that was that it looked like that was an annual expense that was more of a debt expense, and just separating that out from the total payoff amount, where that looked like it was just the same, annual payment they have against debt, not necessarily the balance left over on total debt. So I was just curious.
Gotcha. It looks like is the annual payment. No, that is a balance, and that is the idea, is to pay off the actual balance that is remaining. Is that addressing what you're talking about then?
Yep, thanks.
Excellent. Thank you. Appreciate you asking that. All right, let's see. Here we go. Let me scroll back up. All right, Patrick Lambert, is the amount put in escrow always equal to the agreed upon working capital peg? Yes. The buyers and sellers do need to, it's just like any purchase price. You have to agree upon a final amount before you can actually transact, before you can actually close a transaction. So that escrow amount, yeah, I mean, you're not going to have you'll have advisors from third parties, but they're not going to be the ones that force you to do anything. It's really ultimately between buyer and seller that has to agree on that amount, and that's what it'll put in escrow. There's not always an escrow. That's there again. This is a typical situation, but there are other situations too. Philip, sellers try to hold on to as much cash as possible post-close. Very true. One of the common pitfalls is not negotiating for enough net working capital as part of the purchase. Given the limited data we have from the SIM, how do you ask for that when sending out the LOI? How do you structure the discussion during due diligence? Haha, This is where a financial advisor, a transaction advisor that's specifically for financial due diligence is absolutely important. They're going to be the ones that dig in to, and they're the third party, of course. And I always say third party bias. Now, everybody has a bias. I don't care who you are. I don't care what you think. I don't care what you say. You're biased. Even if it's 1%, you're biased. If you're advising on a sell side, you're going to be at least internally, whether you admit this or not, internally, you're going to be slightly biased towards the sell side. And same thing for the buy side. So just keep that in mind. You're going to be as much as you can to be able to be that third party. So there again, back to your question, how do you ask for that when sending out the LOI? You get an advisor. So at Amplēo, we've put together what we call a pre-LOI package. It's for $4,000, 20 hours. Okay, it's a discounted rate of $200 an hour, where we will look at the deal for you and help you make sure you're understanding. It's not a quality of earnings, but it's a whole lot of numbers, financial due diligence. And we're going to say, hey, you know what, Philip, based on what we're seeing, here's what we're going to advise you to put in the LOI. Okay, so, and we've done a lot of those. I love doing those. I love helping buyers and sellers make sure that they structure a deal very well. There again, you have agreements to prevent disagreements. So love that question. Thank you. To answer my own question, here we go. At LOI, it seems you would only be able to outline the methodology or general adjustment you would use to calculate the final purchase price to prepare the seller for that discussion due diligence. Yes, I have seen, even in LOIs, I've seen them structured different ways. I've seen some where they just have just the dollar figure, but I've also seen some that say, hey, here's a methodology behind it. We're going to put, multiples of this, or based on, TTM period of this. And so I've seen some LOIs really spill that out. So, and those are, I like those because I feel like if you can agree on the methodology, there again, I'll give you a very simplistic example. If you're going to pay $5 million for a company or $1 million for a company, how did you come to that number? Was that a multiple of revenue? I love multiples. We're all in private transactions. We're not public, okay? So you're typically going to pay a multiple of revenue or a multiple of earnings. So if you spell out your LOI to this is a, 1.5 or 1.2 times earnings or 4.5 times EBITDA based on the TTM period, then that gives you a lot of flex right there. Then, because your transaction is not going to close the next day when you sign an LOI. It's typically going to close about 90 or 120 days and sometimes longer after. And those numbers are going to change. And so if you have that methodology, to your point, Philip, then you're able to adjust that up or down. If the company's grown, then a buyer should be very happy with paying that same multiple of that growth. Your company grew. So anyway, that's yes, the methodology is a very good way, and I like that. Thank you. Raul, I'm finalizing an acquisition. Hey, congratulations, Raul. That is fantastic. Networking capital is the last issue to be settled. Yeah, it's always the big question, right? I see a smile coming on your face. As numbers are moving every day, fortunately, on the positive side, good. Hey, we just talked about that, right? We are agreeing to a formula and a table added to the contract so that we have time to calculate final working capital 3 or 4 months post-acquisition. Hey, Raul, can you share a little bit more about that? I would love to hear a little bit more about your insights to that.
Right. So everything has been going smooth. I mean, the due diligence went really well. The thing is that as this business is growing, they manufacture water treatment systems for industrial water treatment systems. So fortunately, they have contracts, and this guy, he just needs help with the volume of work that's coming up. And I told him, the net working capital that we calculated in the last for the last year has one number, but as we're growing, net working capital is going to grow, right? So I promise my investors we're not going to be asking more money So we need to set it up right.
Yeah.
Right now, that's been the issue. So having the right net working capital for a growing business.
Yeah, that's that flex right there. So great example. Thank you for sharing that. And congrats again on closing that or finalizing that transaction. That's good. Nice. Okay, David Sanchez. How would you recommend defining PEG in a business with high seasonality? Ooh, that's the hot question. As depending on timing between signing and closing, numbers can change a lot. Yes, they can. And that's why there again, I'm going to share my screen again and look at this. That's where there again, you've got to be able to have an advisor in there that really helps to understand. So I don't know if there really is a straight question because it's really going to depend upon what that seasonality is. I mean, look at this right here. There's just a whole lot of fluctuations. And that's where typically I like to look at the averages. And so you're looking at seasonality. So there's the averages, but then you're also going to want to look at what's the trend. Are they trending up? Are they trending down? Are they just trending all over the place? And so you make sure that you have an advisor that can dig into the very specifics of that one. Without knowing those specifics, I can't really give you a straight answer other than just say averages and trends. Jacob, are you the same Jacob that was on my last one to ask some great questions? I sure hope so, man. Please email me. Please reach out to me. I'd love to chat with you. Let's see, double click into how many and why this number is calculated, meaning this PEG is determined where a seller and a buyer don't actually earn or lose money, correct? The net working capital PEG shouldn't be a lever to pull and skew the price of the deal one way or another. Jacob, take yourself off mute for a sec and say hello. If you're still on here, if you can. Jacob, you are exactly right. The net working capital PEG should not be a backdoor to try to adjust a purchase price. Okay, keeping in mind that the way that you're calculating it, let me share this again. And keeping in mind there again, this is a simplistic example. We talked about some nuances and everything as well, where you're usually looking at, some target averages and saying, okay, well, based upon I have advised on companies where that average has gone up a lot. And typically when you're seeing an uptrend in the net working capital, you're going to look at a more recent target average because that's really going to factor in that trend. Now, if your average is, let's say, 350, you can't really say, well, we're going to put in 450 here to try to bump, a price or money or anything like that. And the reason why is because really you're going to have to, the buyer is really going to deliver this. Here we go. They're going to deliver this statement for the true up period. And then buyer and seller are going to really dig into the details and renegotiate that. And so if you're trying to bump a price as a seller, with your net working capital, buyer's going to be able to go in and say, no, here's the numbers we're seeing, and you're going to renegotiate that. So the best agreement you can come to is one that will stick and where you guys are going to be able to agree on that base purchase price, and then later that net working capital adjustment as well. All right, let's see. Scrolling back up. Let me see where I'm at. There we go. All right. Arun, what is easier, negotiating net working capital post-close or deducting net working capital from EBITDA to arrive at value? Net working capital is not part of EBITDA. And so which one is easier, negotiating net working capital post-close? I don't know. It just depends upon the relationship. I'm guessing, Arun, that your question is it easier to negotiate what the EBITDA is or the EBITDA multiple, or is it easier to negotiate the net working capital? Arun, will you do you mind kind of helping me to understand your question a little bit more?
So my question was more like, based on the example you're talking about, right? What is easier from, or rather, how is it possible to take the whole networking capital out of the discussion and keep it as a separate aspect of the discussion? Not tying it into determining the value, enterprise value, or anything of sort. But is it possible to just have the networking capital as a separate discussion?
So in other words, you're asking two different discussions, valuation and networking capital.
Yeah.
Not only is that possible, it's absolutely mandatory. Because as we see, and let me share this again, I'm grateful for that question. I want to make sure that we're all understanding. So there's the enterprise value, and we had Marcus's example here too, and I've just deleted that, but we had the example where you've got, a multiple of EBITDA is one thing, your value, and then your networking capital is a complete separate component. Okay. The EBITDA is the earnings of the company based on the income statement. The networking capital is cash and how much cash the company needs to operate. It's based on the balance sheet and the metrics there. So yes, those absolutely need to be two separate discussions. I mean, I say separate discussions. I mean, they're separate components. A lot of times they're happening in the same discussion. And they need to be spelled out, at least the numbers around them in the LOI, and absolutely spelled out in very much detail in the purchase agreement. So does that help? Does that answer your question, Arun?
Yeah. Yes, it does. Yeah.
Okay, excellent. Thank you. Got
Patrick,
go ahead,
I might
Marcus.
just throw it. So that point you just talked about, there's a comment in the chat thread that says, well, doesn't the EBITDA multiple assume that the required working capital is included? And the answer is yes, I think, but what is required may not be what the historical number has been. That was the point I was talking about, where they had way more working capital. And so you need to adjust for that in the valuation. So I think that's same answer, just a
different way to
definition.
Different logistics around it.
Yeah.
Yeah, thank you. Appreciate that. Nice.
May
Okay,
I quickly jump?
Go ahead.
May I quickly jump into this? Thanks, Marcus, for the comment. Follow-up question: how do you determine what is needed to operate the business, right? How do you identify whether it's way more than is actually needed, for example?
So I typically look at bank requirements, because often that's a bank covenant, like what kind of working capital do you need, what kind of FCCR do you need, and you can build that case to say this is excess working capital, so we need a price adjustment.
Thank you.
Yeah, thanks for pushing on that a little more, Christian. Appreciate that. Let's see. Going through, and I hope I'm hitting all the questions. I know we just have a few minutes left. Casey, how do you catch if seller is playing games with working capital? If the seller increases liabilities, oh man, this is a good question here. I like it. If the seller increases liabilities, that decreases the working capital amount in the formula. As a I can't see it. As the buyer, we want the highest amount of working capital. You're inherently at odds, aren't you? The buyer always wants the most amount of working capital, and the seller always wants the least amount. Possible come with the deal. Is there something we should think about from the buyer's perspective to be careful? Yes. I'm going to share my screen again. I'm going to show you, and you'll see this. I've had several questions. Am I going to be able to share the spreadsheet? I'm going to do my best to figure out how to put this on the LinkedIn thing. If nothing else, please email me. I'm going to put my email in the chat here in a sec. Before I forget, hold on a second. Please email me. I will send you the spreadsheets. That way to make sure you have it. And then also, and I forgot to mention at the beginning, if you would like CPE credit for an hour, also email me. We have certificates for that. Okay, so back to your question. Oh, who was it that asked? Oh, Casey, here we go. So I actually have a note right here, and I'm going to show you real quick. As AR decreases, net working capital decreases. Actually, you know what? Let's look at the liabilities, Casey, because that was your example. So as AP increases, net working capital decreases. If a seller increases accounts payable on purpose, I've heard it called different things. I like to call it pushing out the payables. Okay, you're saying, let's not pay that off yet. Let's push it out there. Let's let the buyers pay that off. Okay, in order to push down the net working capital, therefore they're taking all the cash up front and leaving the buyer with all the liability. And there again, that's why you need an advisor to really help you see these trends and see, for example, is days payable going up? You know, and if you see it increasingly, and I've seen this in transactions before, and it wasn't even on purpose. It was, oh crap, we got so occupied and we didn't pay them. At least that's what they represented. Okay. So you really just want to make sure that you're uncovering those kinds of nuances and say, we got to factor that in, for example. Okay, is there something we should think about from a buyer perspective to be careful? Watch the trends. Okay, get an advisor. If you can't dig into financials so much yourself, get an advisor. And even if you can, get someone who's done this 100, 1,000 times, then that way they can really help you to see things like that. So thank you, Casey. All right, let's see. Eric, can you walk through some of the line items of the working capital adjustment? How are they being adjusted on a monthly basis? Eric, I'm trying to think of what your question is. Help me, take yourself off mute for a second. Help me to understand. He may not be with us. They're basically all of these, they're pulling straight from the balance sheet, every one of these. And then these are just formulas. That's all it is. Formulas, numbers, they don't lie. They tell the story. But you got to make sure you understand the story to make the appropriate adjustments.
Patrick,
All right, let's see. Chris,
about normalization
go ahead.
adjustments.
Sorry,
Do you
go
think
ahead,
he's asking
Andrew.
about normalization adjustments?
Oh, could be. Yeah, and that's where there again, for example, let me give an example here. I was on a deal a little bit ago where there was a lot of nuance here in the AR and the AP and the credit. Oh, it was in the credit card specifically. There were some specific credit cards that were and were not included. And so we had several lines of adjustments based on some specific credit cards and everything. Actually, we had several lines of adjustments. Some were credit cards, some were some of the liabilities. I mean, you really got to understand a lot of those specific nuances to say, hey, we're going to, there again, include or exclude, some of these specific items based upon, the history and the numbers. Guys, I know we're not going to get through all these questions. I apologize that we're not. Let me go through one more. Let's see. Christian, is my understanding correct that the typical EBITDA multiple ranges like a 3 to 6x would understood to include net working capital required to run the business? Okay, and I feel like we addressed that a little bit as well.
Yep,
Christian,
that's one we answered.
Okay, perfect. Thank you. Awesome. Nice. I'm going to skip through those. Thomas, an M&A attorney, once told me that the financial professionals would make a killing with an offer where either they calculate and or provide some form of assurance over the working capital amount. Out of curiosity, is this something you or Amplēo have ever done? No, that's the short answer. We will not provide an assurance. We do not provide guarantees about this because there are so many nuances involved. And keep in mind, we are an advisory firm. We're a consulting firm. We are not a CPA firm. I don't even know Big Four firms that provide some assurances. I mean, they do assurance
They do
work
not.
and stuff. Do they? Tell me more about that, Andrew.
They absolutely do not. You cannot possibly provide assurance over that number.
No, I think the question is they are providing that are there some firms that will provide an assurance, a guarantee over that?
Meaning do an audit of the final working capital amount? I'm sure that's possible.
Correct.
But doesn't
Correct.
seem reasonable. Yeah. I've never seen that done in transactions.
And
I
Andrew, is
hadn't
this Andrew
either.
Zinger?
Yes.
Andrew's also one of our consultants as well, who has a lot of Big Four experience at PwC.
Yeah, and Andrew, I hadn't either. I just was curious whether you guys had. It sounded unachievable to me as well.
No, I mean, an audit would take months and months and months. It just would not make sense with both the cost and the timing of it would not make sense. So you do your best during diligence, like Patrick was saying, do as much work as you can to identify what is normalized level of working capital, and then have a structure in place to show how it's calculated and how it would be calculated at close, and just stick to that.
Yeah, I think that was a solid question, and thank you for the answer on that. Guys, our time is up. Oh my gosh, I apologize we weren't able to get through all the questions, but yet I'm not sorry because we've had some incredible discussion.